What are generally considered safe investments that will produce steady returns? Great question. So when it comes to investing, we need to consider the balance of what's referred to as risk versus return. So typically, the amount of risk that you take in terms of an investment should be correlated to the return that you would expect to receive off the back of that risk. And vice versa. If you're getting a high level of risk or you're chasing a high level of return as a result of investment, it is very likely that it comes with an appropriate level of risk. So typically at Aureus, we try and stick to the fundamentals. We don't do anything speculative. We don't do anything that's considered gambling. So when it comes to investing, we split our assets into two sections. There is what's called defensive assets, which are particularly cash and fixed interest or bonds, and growth investments, which is property, shares, and business. So when we're looking at steady returns off the back of safe investments, typically that's associated with our defensive investments. So things like cash and fixed interest or bonds. So basically cash would be anything that you can get from your local bank, having a savings account, a term deposit, anything along those lines. And bonds is where you're essentially lending money to either a government or a corporation in exchange for an interest rate in return, along with them paying back your principal after a period of time. Now, because you're typically lending money to big corporations or big governments like the Australian government or something like that, it is considered a safe investment. But what we need to consider is that because defensive investments are very closely linked to interest rates, not just in Australia, but also globally, that we are experiencing very low returns as a result of that at the moment across the world. So for most people who are looking for defensive investments, they are eventually making the decision to start creeping into or start working with growth investments because they're just not getting the returns they need. Think about it these days, like in a savings account, you'd be lucky to get 2%. So that's not a whole lot, particularly when inflation at the moment is 1.5%. So when it comes to steady returns, we need to consider that in a lot of cases, although growth investments are volatile, you do have the ability to invest in things like Australian blue chip shares that have typically consistent and quite high dividends. So this is all subjective. This comes down to your tolerance to risk. What I'd prompt you and what I'd advise you, Sebastian, is be mindful of what you're actually trying to achieve. Use investments as a vehicle to get you to your destination, and then therefore take the appropriate level of risk based on the outcome that you're trying to achieve. For example, if you can save $10,000 a year and you're wanting to buy an investment property in 5 years, given that you're only going to be able to save $50,000 off the back of your savings, then you need to make up the other $50,000 through investments. And that's likely going to mean that you're going to have to take more risk than somebody who was able to save more or wait for longer. So hopefully that puts that into context.